Once upon a time in the bustling city of Financia, two friends, Amy and Jake, were fascinated by the stock market. They spent weekends poring over charts, watching stocks, and dreaming of big returns. However, they often got tangled in financial jargon, especially when it came to understanding return on equity, RO, and return on capital employed, ROCE. One day, they met Mr. Wise, a seasoned investor, in a cozy coffee shop. Intrigued by their curiosity, Mr. Wise decided to explain ROE and ROCE in simple terms.
Imagine a small business called Amy's Pastries, which you started with $10,000.
That's my equity, right?
Exactly. Now imagine in the first year, Amy's Pastries makes a profit of $2,000. Here's where return on equity, ROE, comes in. RO tells you how much profit the company made with the money you, the owner, invested. In this case, you made $2,000 with your $10,000, which means your ROE is 20%.
So Ro tells Amy how efficiently her investment is working for her. But what about borrowed money?
Great question, Jake. That's where return on capital employed, ROCE, becomes important. ROCE measures the company's overall profitability, factoring in both equity and any debt taken. If Amy's Pastries borrowed $5,000 in addition to her $10,000, her total capital employed would be $15,000. Now, if the profit remains $2,000, her ROCE would be around 13.3%, which shows her overall efficiency, including what she borrowed.
So if ROE measures my own returns and ROC shows how well all capital is used, then ROCE is like seeing the big picture.
Exactly, Amy. Investors often look at both. If RO is high, but ROCE is low, it might mean the company is relying heavily on debt to boost returns, which could be risky. However, a balanced ROE and ROCE suggests the company is efficient with both its own money and borrowed funds.
The friends were delighted. They felt a new clarity about investing, thanks to Mr. Wise's analogy. As they left the coffee shop, they were excited to dive back into the stock market, now understanding how RO and ROCE could help them spot a truly efficient business.